Welcome to the Private Lender Podcast with your hosts from Hard Money Bankers, Jason Balin and Chris Haddon. This podcast is sponsored by hardmoneymastermind.com.
Hey everyone, Chris and Jason here. Thanks for checking out the Private Lenders Podcast. In case you haven't heard about it, we are doing our first in-person event in quite a while in November 3rd and 4th. It's called the Hard Money Mastermind Inner Circle. If you're interested in coming and networking and learning from and masterminding with 20 top private lenders from around the country, check out hardmoneymastermindinnercircle.com to apply, and our program director will follow up for an interview. If you're interested, check it out. Okay. Today we're talking about some good news related to quoting hard money loans and rates. You know, for the past 5 years or so, our rates being like, we're typically at 12.99 or maybe 11.99 for a bigger loan. And those loan quotes, those rates for the past 5 years have come off as kind of shocking and surprising and maybe even insulting to some potential borrowers we're talking to, but that has changed, right?
Yeah, absolutely. You know, forever we've been 12.99 and 3 points. That's typically what we charge on all of our loans. You know, when we started in 2007, we were 15 and 5. Then, you know,
which was market rate.
Then at some point we were at 14 and 4, and then we were at 13 and 12.99 and 3. Never felt the need to come down off that, right? Because there's, you know, I was thinking about this when we talked about this topic of how we talked to other members of the mastermind group and what they charge, and some say, "Oh, well, I'm charging like 10 and 2 because that's competitive." And I just don't think that's enough. Like, the reason we charge 12.99 and 3 is that's the right amount of risk versus reward. Like, there's real time and energy to go into these deals, right? Mm-hmm. And again, if you're charging 12% instead of 13% or 12% instead of 14%, like, if a deal defaults, like, that's not going to make or break it, right? There's no rate adjustments as much for risk. But what there is adjustments for is freaking time and the amount of money you deserve to make.
Yes.
When you're doing these deals. And that's why it's at. I mean, we don't want to do a whole month's worth of deals and make very skinny margins on it and, you know, feel broke at the end of the month.
You know, and I had this conversation with my brother recently, who worked for one of those kinds of lenders for a while. He's since moved on to software, but I just didn't get why these hard money companies that were already operating wanted to take a high margin business and turn it into a low margin business that required lots of volume. And that's what a lot of these shops did over the past 5 years with the institutional money. They felt that it was the only way they could compete. And we just didn't see it. We didn't see that as a good model, like hiring more people, cutting price, ramping up marketing, just basically turning it into a regular mortgage company where you have to have high volume to make any money, right? And so we held our ground on that. And it's possible that we could have left some money on the table by not doing that model and ramping up to like 100 mil or 200 mil. But would it have been worth it? And then having to transition back into a private fund and a smaller company. And like, I think we made the right decision. It's interesting.
Well, and here's
it through though, right?
Well, and here's the other model. I mean, there's very low default rates in general. But that being said, like, you see kind of what our, you know, we know what kind of our back end is, and, you know, the defaults that we manage, and there's not a ton of them, but they still take a lot of work. But imagine doing 10x the amount of volume to make the same amount of income. You'll have 10x the amount of defaults, if not more, because, you know, your quality of underwriting is going to change. It has to, in order to do more and more and more and more volume. And that's where the problem, I think, and this isn't about like bashing institutional back lenders. That's not what this episode's about. We can do another episode on that. But point being is, you know, if we do 15 or 20 deals a month and, you know, whatever, we have a late pay out of a few of them, maybe some other ones run into some problems. Like, imagine trying to do 100 or 200 deals a month. Well, in order to do so, it's not just cutting costs and making less money. You got to up your leverage. Right? You got to up your leverage. So in order for real estate investors to be able to do more deals with you, and by doing so, you're going to inherently have more risk. So it's just a recipe for disaster.
Right. Risk, which may or may not become yours, right? You go into it not thinking it's yours, but that might change once the market takes a turn, according to the agreements that those people sign. But anyway, yeah, So that same topic. So like being a high margin, low volume shop, and in general in real estate has been a good place to be. And I'll tell you what I mean by that. Because there are a lot of people and service providers and industry friends of ours who have taken a drop in volume, right? There are fewer transactions going on. And they need that volume, like a title company or an appraiser or a real estate agent, depending on, the kinds of properties they sell. A lot of them need those units. They need those transactions. And when they get cut by a third, like that's straight to the bottom line, And I would imagine the same for like a low margin lender, regular mortgage lender, like, thin margin, hard money lender sort of thing. So it's been interesting to watch and to talk to people and be like, hey, like we've always been, we do 15 or 20 loans a month, right? Like it's good. It's not like, we do one loan a month and make a whole bunch of money, but 15 or 20 loans a month, that stayed pretty consistent. Some more deals are coming our way. And like HMB typically does, we're just steady Eddie riding it through, right? Like that's typically what our niche does. And even, well, we can talk about the volume thing and then also like how our niche is a little bit contrary to the market in general.
Well, and also, and this differs depending on what size of operation that you want. That being said, that, hey, let's say you're used to doing 8 deals a month and you're only getting 4 deals a month. Well, if you can charge more on those 4 deals, arguably can be more profitable, make more money on those. We encourage a lot of lenders, because a lot of lenders sometimes are scared to charge more, higher interest rates and lower and higher points, because they're scared they're going to lose opportunities and they're not going to be able to work with the same borrowers, or they think they're going to compete. And that might be the case. I mean, listen, we'll be the first one to tell you that, years ago, we did over 100 loans for one real estate investor, and, we haven't done a loan for them in years, right? They were able to find cheaper capital.
7 or 8 years, like many years.
Yeah. And that's okay. But it's the marketing machine that keeps the new ones coming in and coming in and coming in. There's always going to be a need for alternative capital. A lot of the deals that we're seeing right now are some, obviously the fix and flippers that, are having too much trouble going to the institutional back lenders right now. Because keep in mind, the institutional back lenders, the rates aren't much cheaper than our rates right now. Like if you go get quoted by one of them, it might be like 10-1 or 10-2, give or take.
Maybe.
Maybe higher than that right now. So 10-2, 11-2 compared to like 13-3, 12-3, whatever that case is. Like, hey, you can close in a week, very simple, private capital, or you can go through all these hoops and it's going to take 30 days or 45 days. Which one do you choose? Right. So a lot of these high quality real estate investors that are still out there buying deals, they're using us kind of, because they're having a hard time with these institutional lenders. But we also see a lot of kind of alternative deals that are just low LTV collateral based on some commercial buildings and things like that. If you go to buy a commercial building right now and you want to go use a bank, like that's not easy. It doesn't matter how qualified you are. This week alone, we did 2 deals. One, the borrower paid $600,000 for it. We gave him a loan of $300,000. Good credit, had experience. He wanted a little bit higher leverage, but we were comfortable at a 50 LTV on that building. That's what we gave him. Another deal was similar to that, give or take. Those deals are out there, and they're going to continue to be out there more and more. You're going to see them more and more now because there's less competition. And in the past, they might have called you and you quoted them 12 or 13% in 3 points. They're like, yeah, it's a little bit high. But now they're going to their other lender, their main lender, let's call it their bank or institutional back lender. And number one, they can't do the deal at all for them. Or number two, they can, but the terms aren't going to be much cheaper than you. And it's going to be a hell of a lot more headaches.
Yeah. And what we see over and over is like they get a loan quote and they get into process with a lender and starts going down the road. And then sometime during that process, I don't know what happens on the back end or what they find out about the secondary market or whatever, but then all of a sudden they can't do the deal anymore. And I see it in commercial. We see it in residential investment stuff. It's very interesting. And, I was talking to told you a little bit about this, but I was talking to one of our larger capital investors yesterday when I was driving home from the office, and he's a very savvy guy. He's a whale. And he's invested with us for a long time. He also invests with another lender, I think out of New York. And then he also looks at deals from a third guy, but has never pulled the trigger on any of them in the past. And he said that's kind of changed now. Like, he's always liked our stuff because of how we underwrite the deals we choose to do. He's kind of like 50-50 on that New York group. And then the guy was out. He said from all three people now, he's seeing quality deals, right, being presented to him. And he knows what he's looking at in commercial and everything else. And I'm like, yeah, we're seeing a little bit of that too. Like, it's not like crazy. It's not like, we're the only ones with capital, because that's not the case. I mean, any balance sheet lender out there is taking advantage of this.
Listen, there's still plenty of capital out there, which is a good thing. We want capital out there. And Chris and I were talking about this. Yeah. Chris and I were talking about this yesterday, that, over the last week, we've had a lot of payoffs that came in, and we're happy that payoffs are coming in. We want money to be recycled. Even if it's a really good deal that we have in our books, we want to make sure borrowers can get out of it and either sell the property or refinance with a bank. Like, when money's getting recycled and deals are getting paid off, that's a good thing.
Yeah, no, it means the market's still moving, which we need it to. And if some of that capital pulls back because of interest rate and everything else, cool. Is the private capital going to remain in there and be ready? Yes, and that is a good thing.
Yeah. So, no matter where you are inside your business right now, make sure on a daily basis you're out there raising capital, working with your capital investors. You have that capital available for when you need it. You might not need it because you might not have the deal flow right now. That's okay. Keep it available, because
keep it on the sideline.
Deals are coming. I mean, deals have always been here. They always will be here, no matter what. There's always a need for private capital. Deals might look a little bit different, so be opportunistic. Kind of get creative and structure. We had a conversation with one of our partners on a borderline deal this week as well, and we're like, you know what? I don't think that deal is going to fit our mold right now. It might have fit our mold kind of in the past. It was kind of a lower end deal. It was high collateral, but low quality borrower, high construction project. It just wasn't something that we wanted to take the risk on doing right now. Arguably, if we did that deal, it might have worked out fine in the long run, but we feel like there's good opportunities out there, and there's no need to put capital into a deal that potentially will have headaches.
Absolutely. Yeah, guys. So if you are looking to step up your game in the world of private lending and this great business that we're in, you can come work with us directly, and also 20 other private lenders from around the country here in November. Check it out at Hard Money Mastermind InnerCircle.com. And we'll see you next time on the Private Lenders Podcast.
We hope you enjoyed this episode of the Private Lenders Podcast. Please note that the opinions stated by all the speakers on this show are only opinions and not legal, financial, or accounting advice. Please make sure to always check with your own legal, accounting, and financial professionals. If you'd enjoyed this episode of the Private Lenders Podcast, we'd appreciate it if you spread the word. Make sure to check out hardmoneymastermind.com, the #1 free community for new and experienced private and hard money lenders.